Imagine this. You're staring at the charts, eyes locked on a perfect setup. The candles are dancing exactly the way your strategy predicted. You feel in control. You feel ready. You click buy or sell, convinced you've outsmarted the market. But what if I told you that decision wasn't entirely yours? What if every move you made was quietly influenced by forces you couldn't see, forces that profit when you believe you're thinking freely? Stay with me, because today we're diving into the part of trading no one talks about, how institutions shape your decisions without you even realizing it. And by the end, you'll see the market in a way you can never unsee again. When most people enter a trade, they think they're in charge. They've done their analysis, checked the patterns, maybe even waited for the perfect confirmation candle. But here's the uncomfortable truth. The market isn't just a playground where you apply your skills. It's a stage, and the script is often written by institutions long before you arrive. These institutions, the massive hedge funds, the market makers, the high-frequency trading algorithms, operate on a level of influence that goes beyond price action. They have the capital, technology, and market access to shape the environment in which your decisions are made. And the most dangerous part? They do it in a way that makes you believe those decisions are entirely your own. Think about it. You open your charts and see a clean, obvious trend. Price is steadily rising. Every fiber of your being whispers, this is the moment. But who created that trend? Was it truly an organic wave of market sentiment? Or was it an engineered move, a carefully calculated push designed to attract retail traders like you? Institutions can and often do build these moves with large positions to guide the flow of the market. They know that once a certain visual pattern emerges, thousands of traders will pile in, adding more liquidity for them to exploit. This illusion of free choice works because it hides in plain sight. You see the setup, you feel the confidence, but you rarely stop to ask, who benefits from me taking this trade? In most cases, it's not you. Institutions don't need to fight every trader individually. They simply create conditions that push the majority toward predictable behaviors. If they can anticipate what the crowd will do next, they can position themselves to profit from the inevitable outcome. It's like being in a casino. You think you're choosing which game to play, when to bet, and how much to risk. But the house already knows the odds, the patterns of behavior, and the psychological triggers that will keep you playing. In trading, institutions are the house. They've studied retail trader psychology for decades. They know the average stop-loss distance, the entry points most people prefer, and even the kind of chart patterns retail traders find irresistible. Here's an example. The obvious breakout. You've been watching a resistance level for days. The market finally pushes through it with strong momentum. It feels undeniable, so you enter. But often, that breakout is no accident. Institutions can drive price just far enough above resistance to trigger buy orders and FOMO entries. Then, once enough liquidity is captured, they reverse the move, trapping traders in losing positions. You thought you were making a smart choice. They knew you would make that choice. The same applies to sell-offs. A sharp drop in price triggers fear, convincing traders to close positions or go short. But if that drop was engineered to clear out stop-loss orders sitting below key levels, the market can suddenly reverse, leaving retail traders stuck on the wrong side. You think you acted out of caution, but in reality, you acted exactly as they expected. The psychological part is the most dangerous. When you believe you're in control, you stop questioning your impulses. And when you stop questioning, you become predictable. Institutions thrive on that predictability. Every time you chase a breakout, panic sell on a drop, or rush into a trend because it's obvious, you're stepping onto a path they laid for you. To break free from this illusion, you have to shift your perspective. Stop looking at the market as a neutral environment. Start seeing it as a playing field designed by someone else. Someone with far more resources, experience, and patience than you. When you spot a setup, ask yourself, if I take this trade, who is on the other side? If the answer is an institution, think twice. This isn't about becoming paranoid. It's about becoming aware. Awareness is the first step to independence. Once you recognize the patterns of manipulation, the sudden spikes, the fake breakouts, the liquidity grabs, you start to see the invisible hands at work. You begin to understand that true trading freedom doesn't come from executing every perfect setup, It comes from avoiding the traps laid in your path. In the end, the illusion of free choice is a market's most subtle weapon. As long as you believe every decision is entirely yours, you will keep making the moves they want you to make. The goal isn't to avoid losing trades. Losses are part of the game. The goal is to stop playing their game and start playing yours. Fear and greed are not just emotions in trading. They're the twin levers institutions use to move the masses. You might think your trading mistakes come from a lack of technical skill, but in reality, the root cause often lies deeper. It's psychological. And institutions know exactly how to pull those psychological strings to make you act against your own best interests. Let's start with greed, because it's the easier one to trigger. The market knows how badly you want to win, how much you crave the rush of a big profit. When price starts moving sharply in one direction, that sense of urgency kicks in. If I don't get it now, I'll miss it. This is a fear of missing out, or FOMO, and it's one of the most predictable emotional responses in trading. Institutions engineer moves that look unstoppable, knowing that retail traders will abandon their patience and jump in late. By the time you enter, they're often already unloading their positions onto you. The candle that convinced you to buy is the same one they use to sell. Fear operates in the same way, but from the opposite angle. When price drops sharply, your survival instincts take over. Your brain screams, "Get out now before it gets worse." Institutions know this. They can push the market down just enough to hit stop-loss orders and scare traders out before reversing the price back upward. These sharp, emotional spikes are not accidents. They are traps designed to make you act impulsively. The problem is that these emotions don't just cause bad trades. They create mental patterns. After a loss, fear can linger. You hesitate to take the next opportunity, even when it's solid. After a win, greed can cloud your judgment, making you overconfident and careless. The market becomes a roller coaster, not just in price, but in your mind. Institutions count on this instability because it makes you easier to predict. Consider how the news cycle plays into this. Headlines are not neutral. They are crafted to provoke emotion. A breaking news alert about economic collapse, inflation spikes, or political turmoil can cause instant market volatility. Retail traders react, often without checking the facts. Meanwhile, institutions are already positioned in anticipation of that reaction. The fear triggered by the news isn't about the actual event. It's about how traders will behave in response to it. And because fear spreads faster than reason, the crowd usually moves in the same predictable direction. The same goes for greed during bull runs. Positive news about earnings, innovation, or new market highs creates a collective euphoria. Traders start thinking in absolutes. This stock can't go down, or this trend is unstoppable. That is exactly when smart money begins to quietly exit, letting retail traders buy at the top. When the reversal comes, the pain is amplified, not just because you lost money, but because your ego feels betrayed. This emotional volatility is why many traders experience a cycle of boom and bust. You win big, feel unstoppable, get reckless, then lose big, feel devastated, and become overly cautious. Institutions don't have to beat you with every trade. They just have to keep you trapped in that cycle long enough for your account to bleed out. The irony is that the same charts and price movements that trigger your emotions are the very signals institutions use to measure retail psychology. They watch volume surges to see where retail traders are piling in. They look for clusters of stop-loss orders because they know those orders represent fear points. They know how far to push the price to trigger the maximum emotional reaction. Breaking free from this trap requires more than discipline. It requires awareness. You have to start treating your emotions as market data. When you feel the urge to jump in because it's now or never, pause and ask yourself, why now? Who benefits if I act on this feeling? If the answer is probably the bigger player on the other side of the trade, then waiting might be the smarter choice. Likewise, when fear kicks in, don't instantly obey it. Fear can be a survival tool, but in the market, it's often a weapon used against you. Before closing a trade in panic, ask, is this move supported by fundamentals, or is it just volatility designed to shake me out? More often than not, you'll find that the fear was manufactured. The reality is that the market is a battlefield of human behavior, And institutions have mastered the psychology of that battlefield. They don't just fight with orders and charts. They fight with emotions. Every sharp move, every fake breakout, every perfectly timed news headline is part of the strategy to exploit fear and greed. If you let those emotions run unchecked, you're fighting the battle blindfolded. The only way to win is to step outside the cycle. That doesn't mean becoming emotionless. No human can truly do that. It means recognizing emotions in real time and refusing to let them dictate your trades. It means understanding that every moment of intense excitement or panic is a signal. Not what you should do, but what the crowd is about to do. And when you can anticipate the crowd, you stop being its victim. Because in the end, institutions don't just manipulate the market. They manipulate the people in it. If you can master your own mind, you take away their greatest advantage. And that's when you stop being prey and start becoming a hunter in the game they thought they controlled. If you want to understand how deeply institutions influence the market, you need to look beyond the surface and see the tactics they use to exploit retail traders. These aren't just random tricks. They're calculated strategies refined over decades, backed by cutting-edge technology and executed with precision. Once you start seeing them, you realize that what looks like market noise is often the sound of someone else playing a game a few steps ahead of you. One of the most common tactics is the liquidity hunt. Institutions know exactly where most traders place their stop losses, just below recent swing lows for longs, or just above recent swing highs for shorts. These areas are like treasure maps for big players, because stop losses are essentially pending market orders waiting to be triggered. By pushing price into these zones, institutions can force a cascade of stop-loss activations, which adds a liquidity they need to fill their own large positions. The result is often a quick spike or drop that looks like a breakout or breakdown, but instead of continuing, the price reverses, leaving retail traders trapped in losing trades. Another favorite move is the fake breakout. This one preys on the natural tendency of traders to trust obvious patterns. A resistance level is tested multiple times, creating an impression that once it's broken, the price will soar. When the breakout finally happens, traders rush in, but the move was engineered. Institutions push price just high enough to trigger buy orders and draw on momentum traders, then quickly reverse, using that sudden influx of buying pressure to sell into. The same works in reverse for fake breakdowns below support. The trick isn't just in moving the price. It's in knowing exactly when retail confidence will peak, so they can flip the market in the opposite direction. News events are another powerful tool in their arsenal. Institutions have faster access to information than you do. Sometimes seconds, sometimes minutes, but that's enough to make all the difference. They can position themselves ahead of major announcements, and then use the market's reaction to their advantage. For example, they might drive prices sharply in one direction immediately after news breaks, knowing retail traders will pile on. Then, once enough liquidity is captured, they reverse the move. What looks like a chaotic news-driven spike is often a calculated trap. The market structure itself can be manipulated. Institutions can place large visible orders, sometimes called spoofing, to create the illusion of strong buying or selling interest. Retail traders see this as a signal and adjust their positions, not realizing those orders may be pulled before they're ever executed. This false pressure can create temporary market moves that institutions exploit in the opposite direction. Even without spoofing, the sheer size of their orders can nudge the market into areas where they know retail traders are most vulnerable. Then there's the slow grind, less dramatic, but just as effective. Instead of sharp traps, institutions can gradually move the market toward a key level, creating a sense of inevitability. Traders start placing positions in anticipation of the breakout or breakdown, but because the move is slow and controlled, institutions can accumulate or distribute positions quietly without alerting the market to their true intentions. When the final push happens, it's often explosive, not because of organic buying or selling pressure, but because of the chain reaction of retail orders being triggered. One of the most subtle tactics is the use of time. Institutions understand that patience is a weapon. Retail traders often enter trades expecting quick results. If price consolidates for too long, many will close their positions out of boredom or doubt, allowing institutions to take the opposite side. This kind of psychological wear down can be more effective than any single price spike. It turns trading into a mental endurance test, and most retail traders simply don't have the discipline to wait out. These tactics all share one thing in common. They rely on predictability. Institutions don't have to guess what every individual trader will do. They just need to know what the majority will do in common situations. Chart patterns, technical indicators, news headlines, even the default stop-loss distances recommended in trading courses, all of these create predictability. And in a game where money moves from the predictable to the prepared, that's the only advantage they need. Understanding these tactics doesn't mean you can avoid them entirely. No trader can dodge every trap. But awareness changes the way you interpret the market. When you see a breakout, you don't just think time to enter. You ask, is this move sustainable or is it setup? When price spikes on news, you don't just ride the wave. You wait to see if it's a manufactured surge. Instead of reacting instantly, you start pausing, questioning, and analyzing. And that pause is powerful. Institutions profit from the first wave of reactions. By staying out of that initial wave, you remove yourself from the trap. You begin to see that the market isn't just about predicting price. It's about predicting behavior. And when you can predict how the crowd will react, you can position yourself alongside the institutions instead of against them. What makes these tactics so dangerous is not just their precision, but their invisibility to the untrained eye. To most traders, a stop-loss hunt looks like a random spike. A fake breakout feels like bad luck. A news-driven whipsaw seems like market chaos. But to institutions, these are deliberate moves, not accidents. They are tools of control in a game where psychology and liquidity are the real battlegrounds. If you can start recognizing them, you'll begin to trade differently. You'll stop chasing every candle. You'll stop trusting every breakout. You'll learn to let the market reveal its hand before you commit. And in doing so, you will begin to shift from being part of the herd to being an observer of it. In a market built on manipulation, that shift can be the difference between being the target and being the one who survives. If you've seen how institutions shape your choices, how they pull at your emotions, and how they use calculated tactics to trap you, the question becomes, how do you protect yourself? How do you build a mental shield strong enough to trade without becoming just another predictable target? The answer lies in developing what I call mental immunity, the ability to recognize manipulation and resist it not just once, but consistently over time. Mental immunity starts with slowing down. Most retail traders lose not because they lack knowledge, but because they move too fast. The market throws a sudden spike or drop at them, and they feel forced to act instantly. That urgency is exactly what institutions rely on. By slowing your reactions, even forcing yourself to wait for an extra candle or a second confirmation, you break their first line of control. Every pause you take is a step away from their trap. The next part is emotional detachment. This doesn't mean becoming cold or robotic. It means refusing to let any single trade define your sense of self-worth. The moment you tie your identity to winning or losing, you hand over your emotional control. Institutions can then manipulate you simply by making you lose once, because that loss will echo in your next decision. Detachment means you view each trade as just one of thousands you will take over your career. Nothing more, nothing less. Another key is learning to read the market like a conversation, not a command. Most traders look at a breakout as an order, buy now. But if you treat it like a sentence, you start asking, what's the full context? What came before this? What's likely to come after? This shift in perspective makes it harder for institutions to trap you with isolated moves. You stop seeing every price action as a signaled act and start seeing it as part of a broader story. Risk control is also part of mental immunity. Institutions are patient because they can afford to be. They never risk so much on a single move that a loss would cripple them. Most retail traders do the opposite, over-leveraging in hopes of quick gains. This not only increases the impact of losses, but also magnifies emotional swings, making them easier to manipulate. By keeping your risk per trade small, you maintain both financial and emotional stability, making you less vulnerable to fear or greed. One of the most underrated tools in building this immunity is journaling. Writing down every trade, the reason you took it, and how you felt at the time creates a mirror you can't escape. Patterns you didn't notice before, like chasing breakouts after news or panicking after two losses, become obvious. And once you see those patterns in yourself, you can start breaking them. The market is always trying to read you. Journaling is how you learn to read yourself first. Awareness of market traps is essential, but awareness without discipline is useless. Knowing that a fake breakout exists won't save you if you still jump in, because this one looks different. Discipline means sticking to your rules, even when the market is tempting you to break them. It means accepting that sometimes you will miss trades, and that's not only okay, it's necessary. Missing a genuine move is far less costly than falling into a manufactured one. Patience is perhaps the hardest part of mental immunity to master. The market is full of noise, small moves designed to keep you engaged and reacting. Institutions thrive on impatience because it pushes traders into positions without proper setups. True patience is the ability to wait through hours, days, or even weeks for the right moment, while ignoring everything that tries to lure you in before that. It's not passive waiting. It's active observation, storing information until the pieces align. You also have to accept that you can't control the market, only your participation in it. Many traders waste energy trying to predict every move, as if mastery means never being wrong. But mastery isn't about perfect prediction. It's about controlled response. You can't stop a liquidity hunt from happening, but you can choose not to be caught in it. You can't stop institutions from running a fake breakout, but you can wait for confirmation before risking your money. Mental immunity grows over time through repetition. Every time you resist chasing a move, every time you step back from a trade because something feels manufactured, you reinforce that resilience. Eventually, you reach a point where the traps that once pulled you and now stand out in plain sight. You stop feeling the urge to act on every candle. You stop being swayed by sudden price moves or flashy headlines. Instead, you watch them unfold with curiosity, like a chess player observing their opponent's opening gambit. In the end, building mental immunity is not about winning every trade. It's about surviving long enough to let your edge play out. It's about removing yourself from the pool of predictable retail behavior that institutions target. The market will always have traps, manipulation, and games designed to trigger your impulses. But if you can master patience, discipline, detachment, and awareness, those games lose their power over you. When that happens, you stop being another name in the list of retail losses. You stop reacting on command. You start moving with intention, entering trades not because the market told you to, but because you chose to, fully aware of the risks and the context. That is the point where control shifts, not over the market itself, but over yourself. And in trading, that's the only control that truly matters. In the end, the market is not just numbers and charts. It is a living battlefield of human psychology, a place where the strongest weapon is not capital, but control over the mind. Institutions understand this better than anyone. They shape your choices, stir your emotions, set traps in plain sight, and wait for you to move exactly as they expect. But once you see the game for what it is, you can never go back to the old way of trading. You begin to slow down, to question, to observe. You stop chasing every move and start choosing your battles. You stop being a piece on the board and start becoming a player in the game. The truth is, you can't control the market, but you can control how you move within it. That is your only real power. And if you guard it fiercely, if you build the patience, the discipline, and the awareness to protect it, then no institution can truly control you. Because trading mastery isn't about outsmarting everyone else. It's about outsmarting the part of yourself that they're trying to manipulate. Once you do that, the market stops feeling like a trap and starts feeling like an opportunity.